All right, welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker PARA, Paramount Global. Got started a couple minutes late, but nothing too major. Pretty interested in adding this one to the watch list. It's another major entertainment and broadcasting company. We've kind of covered several of those companies on our channel here. I didn't really kind of intend to do a little bit of a side grouping of companies in this industry per se. It wasn't really exactly my intent, but kind of inadvertently kind of ended up doing so. But with the fact that we've had Disney and Netflix in the watch list for quite a long time, and then we've had Warner Brothers Discovery as well, and Liberty Global, that one I'm probably going to either update or get rid of. And then I did AMCX very recently. So, but with adding Paramount to the group, we'll have done quite a lot of the entertainment, broadcasting, streaming companies on this channel. Not all of them. There's a couple other companies in that space that we can cover. But either way, I'll sort of have covered the space in a little bit, at least a broad overview. And that is to say, I definitely haven't done a super deep dive into each of them individually, figuring out the specific mechanics of what would make the subscribership grow in specific areas. I've definitely taken a more simplistic, broad overview of each of these, so that should all be taken as a solid grain of salt when looking at any of my valuations. That I definitely take a pretty simple approach to the valuation at hand. Either way, it's looking at our watch list here and see the other companies that we valued over time. This week, I definitely made some more purchases in Smith & Wesson, as I've been doing pretty regularly so far over the last couple months, as well as Turtle Beach I bought a little bit more of as well, and Inter4. Those have kind of been a lot of the companies I've been buying a lot of regularly, so that's should be no surprises for people who've been paying attention there. Also, we are expecting some pretty shaking economic news here tomorrow with the end of the most recent Federal Reserve meeting. It's expected that they're going to raise the benchmark interest rate by about 75 basis points, though some people expect that it could possibly be a full percentage point, but most of the market seems to expect about 75 basis points, so that's generally what I would expect as well. But who knows, very well could be that full basis point hike. We did also get some economic news, though that didn't seem to be very much noticed today, with housing starts were released today, which came in a little bit better than expected. But that good news, like I said, was a little bit overshadowed by the fact that the Federal Reserve meeting started today. And so everybody's kind of expecting that news tomorrow and placing their bets today based off of those expectations. So over the last couple weeks, I've been kind of working pretty hard behind the scenes on a couple little side projects. One of them being my DCF template, my new template that I've been working on all year, which is to say I have been working on it all year, but in the last month or so, I've really gotten a lot of work done and being able to put the pieces together into a more solid piece. So kind of wanted to at least kind of preview that a little bit here, showing what I've got. My new DCF template is going to kind of organize all the financial statements into a nice, easy to read format, hopefully, including graphs, as you can see, this being the income statement section. I'll have a cash flow section, as well as a balance sheet section, and then also quarterly columns for 5 years up for each of them as well, including income statements, balance sheets, and cash flow statements, as well as trailing 12 months, as well as there will also then be separate sections for creating revenue margins and investment assumptions for the future, and creating distributions for the total valuation. So definitely not done yet, but it's really coming along pretty solidly, and I'm very impressed with the work I've gotten done in the last couple weeks or so. And then also this weekend, I kind of did a whole little side project all together, which isn't quite done, but it's a lot less work, so I was able to get it done. But this has been something that's been kind of in my mind and on as a back burner project I wanted to get working on, which is to say that in my evaluations, I use the average margins in sales and capital ratios and betas pretty regularly. I reference these things as data sets that I get from Aswath and Motoron, of which, by the way, I made a video on information that you can get from Aswath and Motoron. I would highly recommend people watch that video that I produce, Learning from the Dean, which you can find on my channel, where I talk about in the video the massive amounts of archived data sets that Aswath has on his website, though each of them are separated off by year, which it's great that he has all this information, but it's annoying that all the spreadsheets are separated off by year so that you can't necessarily get an idea of longer term averages of the margins or the sales and capital ratios over time. And so this weekend, I endeavored to fix that by essentially taking all these spreadsheets and combining them into one total spreadsheet, which is sort of what I got going on here, where I have different sheets for each of the different metrics, and then a time series of 5 to 8 years, depending on which metric it is, showing those things over time. So I have betas over time for the industries, unlevered betas, gross margins, R&D as a percentage of sales, SG&A, stock compensation, operating margins, adjusted operating margins, tax rates, net margins, sales to capital ratios, debt to equity ratios, cash as a percentage of enterprise value, working capital, accounts receivables, inventories, all sorts of stuff. And like I said, I'm not even done yet because Aswath really has just that much information on his website, but I wanted to put together one spreadsheet where I can really take a look at all this information in totality. And also, like I said, I wanted to use it in my own valuations rather than just relying on the most recent of operating margins, so to speak, for an industry, and then kind of thinking, well, they had a very profitable 2021, and then having to take that into account, which I find really annoying to have to deal with. I wanted to be able to take a look at 3-year averages or 5-year averages or maybe even 8-year averages. It breaks off at 8 years, unfortunately, because if I go back further than that in Aswath's data sets, then they don't actually list it by the same groupings. And I wanted to at least keep the same groupings. So the point is, this new data set that I worked this weekend on, I think is going to be an invaluable tool in my work in future valuations moving forward. So with that, we'll get into Paramount. I'll start talking about the actual valuation at hand. It is a pretty interesting company that's gone through a lot of interesting corporate reorganizations over the last few years or so. I shouldn't put this here. It was founded in 1986, and under, I believe that would be specifically the Viacom bridging of it, because as I was just kind of mentioning, the company's gone through a lot of restructurings and recombinations and mergers over the last few years. But with 2017 and 2018, it was a merger between Viacom and CBS, where it became Viacom CBS for a few years, and then in the most recent year or so, is then transformed into Paramount Global. So it's kind of gone through several bridgings of its brand name over the decade or so, which is not entirely uncommon in the media and entertainment space, frankly. You see quite a lot of that stuff. It does trade on the NASDAQ. The CEO, Robert Bakish, he came into the company with the most recent combination. So he was elected when he joined the company, so to speak, from 2019. And he actually joined over from the CBS bridging himself. So he's gone from company to company through these corporate mergers and recombinations. I have it sectioned off into the entertainment industry, though, like I said, being that it does have quite a bit of television broadcasting segments, you can also consider it part of the broadcasting industry as well, but primarily entertainment. Top competitors, as we kind of already discussed a few of them at the very start, we have Netflix, Disney, AMCX, like I just kind of recently covered, Comcast, Apple, a few others. You could cover basically anybody who competes for entertainment or mind space, so to speak, in timeshare. Their next reporting date is expected to be November 4th. And I couldn't find specific information in their transcripts when I was briefly looking of revenue guidance, though I kind of found references to guidances. So I think I might have actually just missed that. And frankly, I didn't actually devote a huge amount of time to looking for the guidance, because I was actually more specifically focused on some of the analysts' reports that I was reading specifically for the company. And with that, there is actually 25 analysts that are reporting revenue numbers for 2022, according to Yahoo, at approximately $30.6 billion or so, with $31.8 billion being the estimate for 2023, also from 25 analysts. We have EPS estimates, adjusted EPS estimates for 2022 being $2.31 according to 23 analysts, and then 25 analysts say $1.65 for 2023, which I just said 2023 here when I meant 2022. But either way, interesting to see that there is an expected decline in the EPS, even though there's an expected rise in the revenue. So there is a pretty solid expected excess cost in the next upcoming year, according to the analysts. And I'm definitely going to be using this information to guide my own assumptions about the margins in the short term, which I'll definitely get into once we get through all the numbers. The trailing 12-month dividend has been 96 cents per share, which is expected not to change, and the current forward dividend is also expected to be 96 cents per share, which comes out to be 4.25% over the current share price. And there is also a $2.36 billion authorization for share repurchases, which equates to about 15.5% of the current market cap. So a pretty decent amount of shareholder total return on the table, so to speak, for Paramount Global, which is pretty good and interesting, especially because we'll get into some of the specifics. I'll kind of like, I guess you could say, spoil a little bit of the end, so to speak, which is that no matter what the assumptions of the revenues and the margins that I put in place, I sort of end up with the same net profit, not adjusted for cash flow effects, that I in the 5-year forward period is effectively that they've had on average for the last 4 years, which is the time period since they did their most recent merger and combination, which is most representative of the current company. So the point is effectively speaking, I don't really see their net income changing too much over the 5-year period over the long term, which means that the only growth in the stock is likely to come from massive amounts of repurchases. Which means change in EPS. So, like I said, you want to see this buyback authorized because effectively it's going to be the only way the company is going to grow, being that it's so mature of a company. Even though, yes, like I said, there is expected to be revenue growth. So, like I said, we'll get into the specifics of that in a bit. About 5.39% of the shares are currently held by insiders. 2.1% increase in the last 6 months. So definitely there has been some insider purchases, but nothing too major there. 80% of the shares outstanding held by institutions. 8.72% of the shares are currently short, with that being 9.83% of the current float due to the percentage of the current share count that is offload. The short ratio being 5.95 days, so close to 6 days would be required at current volume levels for shorts to cover, which the current 10-day average volumes is 13.49 million shares relative to the 3-month average volume of 9.35 million shares. So the current volumes are a little bit heavy relative to what they've been over the more recent midterm, with the short ratio being a little bit elevated, not super elevated, but it's starting to get a little bit elevated. So some of those shorts might start to get a little bit antsy, effectively speaking, is what that sort of means. So we can get into the segmentation, actually, before I'll get into that, I will actually point out a couple of the specific details from their earnings release, talking about at least some of the successful details of the business over the last year. They did talk about their total global direct-to-consumer subscribers reaching 64 million, which is on effect of including the removal of Russian subscribers, close to 4 million there, which they did also have an addition of 5.2 million subscribers to get to that net add up to 64 million. So pretty good growth in overall direct-to-consumer subscribership. However, the overall revenues coming from the direct-to-consumership is still relatively low comparative to the overall revenues. So there still is a large amount of TV media and films entertainment revenues that are going to be cannibalized over time into the direct-to-consumer, which the real question is how much of that is going to be a cannibalization versus actual organic growth. And that is to say that they actually do have some avenues for strong organic growth, what with the success, for example, of the filmed entertainment segment that they had over the last year. In particular, for example, the success of Top Gun Maverick, which was like one of the most successful movies in the last several years. A lot of people really rushing out to go to the theaters for that. So while they do have a large cannibalization of mostly, I would say, their TV media, because obviously the filmed media is going to go direct to consumer as well, but the ability to get people to the theater specifically for a theater specific experience, I think they've shown their ability to be a little bit resilient with that in the last couple of years, especially due to the pandemic. In fact, before the pandemic, I really didn't have that opinion too strongly, but I definitely revised my belief that the theater industry was essentially like going in the complete wayside. Obviously, I do think it needs to concretize itself and really streamline itself a little bit and decide what movies are worth the theatrical approach. But things like Top Gun have really shown that they can actually still maintain that as a separate segment beyond just cannibalizing all the other media into direct consumer. So anyway, getting into the actual segmentation of their business, as I was saying, I'm going to basically be treating them as half broadcasting, half entertainment, which for the unlevered beta sales to capital ratios and net margins, I'm able to use the longer term averages that I was talking about with the data sets that I've provided. So that's one thing that's really neat about this is now I actually have 5-year averages, or actually I used 3-year averages for the sales to capital ratio and 5-year averages for the net margins, so that I can get an idea of where the industry is currently investing for the capital, and also longer term sets of margins for the industry that's not affected by the most recent year of 2021, which, for example, was a very profitable year for a lot of companies. Whereas, for example, 2020, you had the reverse problem, where a lot of margins were negative. It was a very unprofitable year for a lot of companies. So looking at the average margins of cross industries in 2021 or 2020 has been a little bit of a pain in the neck. So now I can look at 5-year averages, which gives us a little bit more of a consistent idea of what the industry is actually doing. So either way, on industrial expectation, the unlevered beta for the company I have is 0.9, and then the sales capital ratio is 1.14. So that's $1.14 in revenue for each dollar of capital invested in the business. Which, to be honest, I'm a little surprised to see that the sales capital ratio expectations for the entertainment industry would even be that high, relatively speaking, because of how much capital has to be invested for the content spend in the industry, relatively speaking. But I would say maybe the growth just got a little bit ahead of the industry over the last few years in that sense. But also the adjusted net margin expectation being 9.15% or so. And we can also compare those to where they currently stand with 9.15%. They actually had a relatively high margin comparative to that. And also in the sales capital ratio, they have a relatively low sales capital ratio compared to their industry. So a little bit higher on one end, low on the other end, which is about the balancing out effect that I typically like to see. 81 to 82% of their revenues coming from the United States, 18% from international, also with about 94 95% of their assets attributed to the US, with 5% international. That brings them to an updated ERP for the company of 5.71. With the unlevered beta of 0.9, they have a debt to equity ratio of 126 to 127%, which comes off of the back of their debt and lease liabilities of $19.6 billion, at a rated average maturity of 13 years and an interest rate of 4.8%. So not a bad interest rate, a pretty reasonable interest rate, a very good maturity profile. They actually do have very stretched out debt, so it gives them a lot of time to deal with paying out the debt, which is good considering how much debt they actually have. So I mean, 127% percentage rate of debt to equity is a huge amount of debt comparative to your market cap, so it does give you a decent amount of excess risk for your business. But it is good that they have so much time to pay it down, effectively speaking. But that does bring their levered beta up to 1.76, which brings their cost of equity up to 13.64%. But due to the fact they do have so much debt, that does mean the cost of capital is not that high. It does stay at about 8.28%. So that being the segmentation, we can get into the financial history for the company as I have it between the years of 2012 and 2021. So in 2012, they were effectively a different company, as we were kind of talking about the mergers and combinations that they've gone through over the course of the business. They made the combination with Viacom and CBS all together in 2017. So you can see here between 2016 and 2017, their revenues effectively double. So you can see it's sort of a different company, so to speak, between over the whole 10-year period. But either way, their sales did go from 12.8 billion in 2012 up to 28.5 billion in 2021. So outside of kind of that, you can kind of maybe look at from 2017, it went from 26.5 billion up to 28.5 billion. So if you're just focusing on that section of the business, and it is also half as long, but you can see there's much less growth to be had there. Really just 2 years of rolling 3-year period. So we can kind of look at negative 2% for one of them, and then it flipped up to a positive 2.5% because of a nice growth spurt in 2021. So maybe, about 2% per year growth or so over the 4-year period that we have effectively look at of the combined entity of Viacom CBS. One thing you can note, however, is that the gross margins are remarkably stable between the two entities, however, because for example, up through 2017, we have a gross margin of about 40.5%, and then also about 40.2% or so. So effectively the same gross margin, which also, oh man, I just realized I actually I closed the file, but I should have left it open. But I'll actually pull open the industry statistics spreadsheet that I put together, because as I had noted, I have more information here across the averages over time, including also information for the gross margins. So we can take a look at the gross margins as well. Gross margin average for the 3-year average for broadcasting 46.2%, 48.1% for the 5-year average. We can average those in with the same thing for entertainment, 40.7 and 41.3. Between all 4 of those, just getting an idea, it's 44.1%. So 44.1%, and then Paramount Global has gross margins around 40%. So you can say the gross margins for Paramount comparative to their industry is a little bit weak. It is interesting to see that they've had as consistent of a gross margin between the two entities of their business, but the gross margins do come out being a little bit weak relative to the industry as a whole over the short and longer term. Which is interesting to say, because also if you come down here to the reported net margins, you can see that the reported net margins does not necessarily is that the case. For example, prior to them combining Viacom and CBS, they had average margin of 14%, and then after the combination, an average margin of 11.8% or so over the entire time frame, averaging 12 to 13%. So for the combined entity, 11.8%. Industrial averages, we can come over and take a look at that as well. The industrial averages for that, let's see, for 3 year and 5 years, because we won't include the 8 years since we're not including the period prior to them combined together. The averages for them ends up being about 9%. So what you can see is that they're actually higher than their industrial expectation for net margins, so to speak, even though they're lower than their industrial expectation for gross margins, which is very curious, especially considering they have as much debt as they do, because if you would expect it to sort of be the other way around, or maybe they have high gross margins, but they've managed to lose the effectiveness of that by having so much debt, which then drags down their net margin. But instead, we have this weird kind of contradictory setup where their gross margins are relatively low, and they have a huge amount of debt, which you would think would weigh down their net margins even further, but somehow they end up with net margins that are actually higher than their industrial expectation across the short term and longer term. I didn't actually look at the specific averages comparing it, as I do have a sheet in it for SG&A in here, for example, but I do imagine that it does have to do with SG&A. If I did actually take a look at that, I don't have a line in here in the spreadsheet for SG&A as a percentage of sales, which is why I'm not going to do it. But I imagine their SG&A levels are relatively low relative to the industry. That's basically the only thing that would explain it. And that is not necessarily something that can last forever, especially, for example, if their gross margins are lower than in their industry, which would show that they don't necessarily have a strong competitive position relative to their industry. So that would argue that their SG&A costs are likely to eventually have to go back up relative to the industry. Just some speculation there, which has to do with some of my margin assumptions for the future moving forward. So I kind of wanted to bring that up here. One thing I did also want to note, which is something that I had kind of mentioned earlier, is that the recent average since they have combined as an entity of their net income is 3.2 billion. So that's what I kind of mentioned there, that I didn't think that they're going to necessarily grow beyond that. Their current most recent net income was 4.5 billion or so. But the average since they've combined Viacom and CBS was 3.2 billion. Anyway, so moving down the line to cash flows, we can take a look at that to get an idea of like how the business itself is reinvesting overall its cash flows for growth in the industry. Now, this adjusted net capex line down here, this is the line where that includes both capital expenditures, depreciation, amortization, changeovers in cash flows of working capital, as well as acquisitions. So it's effectively includes all the things that I count as forms of reinvestment and boils it all down into one number per year, so that we can get an idea of truly what is the actual net growth cash flows for the company. One interesting thing to note here is that for all 10 years, we actually see no negative numbers, which is not exactly super common. For a lot of companies, you might see on average strongly positive numbers, but you might see a positive number here, a negative number here, positive number here, negative number here, as companies kind of ebb and flow with the movements of the business. One interesting thing to see is that this entire line is positive, which is just kind of, like I said, not super common, which that shows to me is that they're constantly putting cash flow into the business as part of keeping the business moving. Like growth, cash flows is a necessary aspect of the business, not necessarily just to grow. Obviously, they actually have been growing over the time frame, although, like I said, you can kind of segment it off into two different businesses at two different points. But either way, so the point is definitely huge amounts of cash flows being invested in the business. For example, over the period since they combined Viacom and CBS, averaging about 1 billion or so per year. In the last 3 years, it averages about 1.2 billion or so. Taking a look at the free cash flows of equity, which is free cash flow minus or plus the issuance of debt in the given year. So it takes debt into account. The cash flows that they had to pay out to their shareholders also. For the first 5 years of the period, which is also prior to them combining Viacom and CBS, it averaged 2.4 billion or so. And the amount of cash flows that they did pay out to their shareholders during this period was 2.8 billion. So they did overpay their shareholders for that first 5 year period, but that was also, like I said, when they were effectively a different company. So you can kind of give them a little bit of the benefit of the doubt there. Not to mention it was also the first 5 year period. I usually give a company a little bit of benefit of the doubt for the first 5 years, as long as they do better than the second 5 years, and especially if how much they do better in the next 5 years makes up for their overpayment in the first 5 years, which for example, if we do take a look at the average for the full 10 years, it ends up being 2.1, 2.2 billion. And the total amount that they do pay out over the total 10 years is 1.6, 1.7 billion. So the total 10-year period, it actually does make up for that effect, because of the fact that for the next 5-year period, they had an average of 1.9 billion to 2 billion or so that they could have paid out to the shareholders. And then the amount that they did to pay out to their shareholders per year on average ended up being actually 575 million per year for this next 5 years. Partially because of they stopped growing their dividend in 2020. Well, that's one thing that had a decent effect on it. Not to mention they also stopped doing massive share buybacks once they did the recombination of their business. They started doing much smaller amounts of share buybacks relative to what they had done before. And in fact, they also did a pretty significant dilution in 2021, which effectively erased some of the previous gains we had there. So reasons for that, but effectively it shows that the management understood that the management prior to the combination was effectively doing things wrong, and so now they're managing their cash flows in a much better way. So coming down the line, we can also take a look at the returns on invested capital for the company over time. For the entire time frame of the historic period that we're looking at, they had returns on invested capital of 15.75%. Prior to them combining with the two companies, it was 15.4%. So for the next 5 years, it was about 16%. So there is technically a slow movement upward in returns on invested capital since they've combined the companies, but not really that dramatically. It's really about in the same position as it was. In fact, you can see that really it had jumped upward while the new sales was effectively still adjusting with the new balance sheet. So this is kind of an anomaly here, so to speak. And then it eventually started stabilizing into these teen levels, what with the outlier 2020 in there. For the last 3 years, averaging about 12.5% or so. Returns on equity are substantially higher than the returns on invested capital. So that's one thing that we like to see pretty consistently prior to the combination and after it. The prior being about 29% or so for the returns on equity, and then after it being 47% or so. Though again, we do have this outlier of a year, especially in 2017. And then technically 2020 is an outlier as well, but on the return on equity, it appears like less of an outlier. The whole period, it averages at 38%. So yeah, very, very strong boost of the returns on equity from the returns on capital due to the leverage that they have. Lots of leverage, but they at least are getting something from it, is basically my point there. So now we can come down to the balance sheet to take a look at exactly just how much this debt is actually weighing them down. Do we actually, maybe if we're looking at it from the balance sheet perspective rather than from a market cap and income perspective, does it start to look a little bit better? That's kind of like, I don't know, one way to sort of think about this. We can look at the cash levels. The cash levels for the company prior to them doing the business combination, they had an average of $483 million in cash for those 5 years. Relative to the current assets, they had 5.6, 5.7 billion or so. And then that's pretty close to what they had ended that period with. So not a huge amount of cash relative to their current assets. The 5.6, 5.7 billion relative to their current liabilities. That's pretty healthy. That their current liabilities being 3.8, 3.9 billion means they did have pretty significant wiggle room for their current liabilities. And then taking a look at their total debt, we can see that the longer term debt was about 7 billion or so as an average for those first 5 years. Then that's really where things actually do start to change over, is because they did take on a significant amount of debt when they did the combination, or really just the consolidation between the two balance sheets, effectively speaking. But then the total current assets ended up being an average of 12.1 billion, ending at 16.6 billion, versus the current liabilities averaging 7.8 billion. So still pretty significant leeway there, and then ending at 9.4, 9.5 billion. So the current liabilities and the current assets is still a pretty significant headway. However, the total debt has now jumped up to an average of 17.5 billion, ending at 19.2 billion. And then, you can add the current debt onto that. It's, it's somewhere in the range of 20 billion or so in total debt, as we kind of talked about when we talked about the debt profile a little bit earlier. And then 20 billion, again, as I was saying, the average incomes that they've had are effectively somewhere around 3.2 billion. 20 billion, 3.2 billion, that's, maybe somewhere in the range of 7 years of net incomes that would be required to pay down the debt. So pretty significant amount of debt relative to the incomes. 20 billion of debt relative to 58.6 billion in total assets. So a pretty significant amount of debt relative to the assets, but I would say that's definitely not a catastrophic levels. The total liabilities end up being 35.5 billion relative to 58.6 billion. So they do have significant assets relative to their liabilities. The total retained earnings This is one thing that I would say that they do actually have one thing in their favor, is that when you see these combinations between companies halfway between the historic periods, as we've often done with a lot of our valuations here, very often when they make that move, it almost feels like they're ruining their equity statement when they do that. They end up going from having retained earnings to seeming like giving up the retained earnings to somebody else by taking on some merger of some sort. But here we actually see negative retained earnings, negative 26, 27, up through 2016, negative 19 billion, and then now they actually stabilize their equity statement by combining those two companies together. So that's one thing that I actually do like between the two companies. You can see that the ratio between the total assets and the total liabilities changed dramatically. There was a much smaller percentage between the two relative to after the combination, and you can see that, like I said, but by having a much stronger average retained earnings between the time frame. They did have positive equity overall, regardless of that, but you can see it kind of went from a much thinner slice to a much fatter slice. In fact, a thinner slice that was shrinking to a fatter slice that is now growing. And that also has to do with the same thing that I was commenting before about the fact that they stopped doing such massive share buybacks and stopped growing their dividend, and instead have focused on maintaining market share and expanding it, if anything, rather than just paying out massive amounts of cash flows to shareholders. Though they're still doing that, they still, as we were saying, they still have a significant share authorization in place, and they still have a decent dividend. That they just stopped growing the dividend, and the dividend's 4% regardless. So it's like, okay, so still pretty healthy regardless. So now we can come down to take a look at their PE ratio. That's one other thing I kind of wanted to point out, is that they kind of had a similar interesting changeover between when the business structure changed post merger. Their PE ratio averaged about 16 or so prior to the combination, ending at 21 or so, and then ever since then it's averaged as about a 7 or so, and it's currently at about 3.5. So obviously the expectations of the market has applied to the company dramatically shifted since the merger had been in place. You can see as maybe the market perceived potential for the company prior to the merger, and then saw it as the potential being fulfilled once the merger was in place, so to speak. So they basically put themselves into a mature state by putting on the merger. But I don't necessarily think that logic really holds through necessarily, because of the fact that they haven't really had I would say changeovers in incomes that are necessarily commensurate ever since then, because it's approximately as though they doubled their net income, or a little bit less than that, even though they doubled their profit. In fact, like I said, or profit doubled, they doubled their sales. They doubled their sales, but they did a little bit less than doubling their profit on average over the 5-year period. And so you would expect them to maybe have done a little bit more than doubling. If they doubled their revenues, so to speak, there should be a leveraging effect in there, and they didn't really achieve that. So it feels like the market kind of rewarded them for that regardless. So coming out of the sales to capital ratio, the kind of last metric that we typically use for measuring our investment for cash flows for the future, you can see the average that the company had prior to the combination between the companies was 0.92. So that's 92 cents in revenue for each dollar of capital invested in the business. And I had remarked on this when I was talking about the sales capital ratio for the industry, that I was surprised to see it above $1, because usually entertainment does require significant amounts of investment in order to be competitive, and so it does typically have a little bit of a suppression to that effect. And so you can see that this is a little bit closer to what I would have expected. Not necessarily super low sales to capital ratio, but at least maybe around $1 and below the dollar. 92 cents, that kind of makes sense to me. 2017 is a little bit of an outlier for the same reason as we kind of talked about before, for a few of the other reasons. They didn't quite, the sales and the balance sheet hadn't quite adjusted at the same time, and so we have this weird outlier number there. We can effectively ignore that. And then the sales capital ratio, since it then adjusted in the combined entity, has been 0.81 or so. So that would be 81 cents or so in revenue for each dollar capital invested in the business. For the last 3 years, on average, it's been 0.77. So it's actually been trending downward, which I think that actually makes sense in terms of their competitive position. That means that because of they're not exactly the top dog in the entertainment industry, so to speak, and especially in the streaming aspects of it, which is the growth avenues that they're trying to approach. They kind of have to take second fiddle, effectively speaking, in pricing, which means that they don't necessarily get the best talent. They have to pay higher to get the better talent, and that means it's going to cost more for total investment. So seeing that their sales capital ratio has been trending downward over time makes sense to me, especially relative to the fact that, like I said, they have relatively high margins compared to their industry, which means that they're essentially making that business choice effectively. They're saying, well, we want to keep our margins in place, relatively speaking, here, which means that we are sacrificing the ability to invest future in there. However, I do think that this does have effectively a bottoming out effect at some point or another, and they may have already reached that. You can see, for example, it did grow from 2020 up to 2021, and then since their industrial average is so much higher, I do think it's pretty reasonable to assume that they might start to drift upward a little bit over time, and I would actually imagine that their margins would drift downward over time. So I would actually start to see these two means revert effectively in my projections over time, which is part of the assumptions that I have in place for the company, which we'll start to get into now. Now, as I kind of said at the start, keeping this relatively simple. I didn't put together any special revenue model for the company based off of subscribership or anything like that. I'm keeping it pretty simplistic. I didn't really want to do anything too complex on that. Just kind of wanted to get a brief overview of the company. So I'm mostly going to be relying on Yahoo and its thoughts relating to the analysts. As I kind of already covered, the analysts are assuming about 30.5 billion or so in revenue for this year, and then 31 to 32, close to 32 billion for 2023. And then they're also assuming EPS estimates of what was it? It's $2.31 for this year, and then $1.65 for next year. Now, what with the limitations of my spreadsheet, there's only so much that I can do to simulate revenues the way I want to, and so effectively, I'm not going to make the short-term revenues necessarily super accurate, especially in line with the analyst assumptions, but I am effectively going to make my expected revenues pretty close to essentially the analyst assumptions, but about $1 billion higher. So a little bit more growth to be had, a few percentage points more to be had once they get to the 23 numbers, but I'm essentially assuming that they're going to have basically very little growth, as they're mostly going to be cannibalizing their previous businesses over that time frame. So my short-term revenues are a little bit sandbagged relative to what the Yahoo estimates are going to have, but I'm mostly just focusing on keeping the longer-term estimates in place where I want them to be. So my longer-term revenue on an expected basis is going to be 32.7 billion or so, which comes with a negative 10% decline in revenues in the worst case scenario and 12% growth in the best case scenario. So I could see significant growth in some scenarios and significant decline in other scenarios, but on net, I don't necessarily see a super amount of growth. I'm seeing it pretty much flat once we get to the 2022 numbers. Now, I am also shifting the probability distribution around, which is a little bit different than what I've done for the vast majority of my most recent valuations. I've mostly just left it at a pretty normal distribution. So I did shift the probabilities around to essentially lay this in the way that I wanted to, which is to say that I wanted to have lots of downside potentials without necessarily weighing as heavily towards those outcomes, because I do think it's much more likely that they're closer to like 39 billion, for example, than they are to 22 billion. So I definitely wanted to make it significantly more likely that they do lean towards this more optimistic scenario. So that's partially how we end up with expected revenues of 32.7 billion, even though the median case right here shows it to be 30 billion, because we actually have 30% of the weight towards this fourth model. So there is actually a pretty heavy leaning towards that, even though, like I said, I'm kind of sandbagging the short term for the revenue. And the reason why I feel comfortable doing the sandbagging for the revenues is because I am actually going to hit them pretty hard in the short-term margins. And at the end of the day, it's the bottom line that matters, right? That's what matters. And I'm doing this partially off of the back of the assumptions that we got from the analysts. So the analysts are assuming 2022 numbers are going to be $2.31, and they're assuming the 2023 numbers are going to be $1.65. So they're seeing a significant excess in streaming conversion costs and stuff like that, and excess entertainment costs moving forward over the next year or two, especially in 2023. And so I decided to essentially take my 3-year average of the margin, with a 3-year average, which is 12.5%, and I actually cut it into a quarter, so 25% of that. So in the short term, I have a base at 3%. So the short term margin is going to be something closer to 4% in the next year or so, which gets me 1.2 billion expected net income, which gets me an EPS of $1.87. And again, that's the 2022 number, because again, my spreadsheet has limitations. So 1.2 billion in 1.2 billion in 2022, and then that's going to be 1.6 billion in 2023. And so I kind of had to sort of choose where I wanted to simulate these higher costs that the analysts are perceiving. But then I do have it go from this very low margin in the short term upward towards my more significant longer term margin, which I'm going to have at 9.5%. Is on a band between 1 and 15%. And like I said, I did have the probabilities lean towards the more optimistic outcomes. which leads me to 9.5%. Now, as I was just saying, their margin since they combined as a company has been 11.8%. So to say that their long-term margins are going to come down to 9.5% is to say that their margins are going to take a significant hit over the longer term, which is partially of the things I was just saying before. I was talking about they have a significant amount of debt, though that has pretty good maturity, so they don't really need to roll that over. But their poor gross margins, their low sales capital ratio, and their attempts at growing their subscribership and cannibalizing their previous businesses does lead me to believe that they're going to have lower margins in the future as they adjust to this newer outcome. So I'm bringing their margins down and I'm bringing their sales capital ratio up, which, like I said, I'm kind of reverse mean reverting the two measures. So 9.5% is the expected margin that I'm going to have for the company. Though I am in worst case scenarios having to go down to 1% and in the best case scenario up to 15%. So it is a pretty wide band of margins because effectively I do think that there is large potentials for variability in the short term in any given year. And then now down at the sales capital ratio, I do have that on a band between 0.25 and 1.25, which gives us a median of 0.75, which is close to their current sales cap ratio, which is 0.78. Again, that's 78 cents in sales for each dollar of capital invested in the business. In the last 3 years, this on average has been 0.77. So like I had kind of commented before, that it seems like maybe their sales capital ratio had bottomed out and they're starting to bring it back up a little bit. So I'm actually going to do the same. And I'm going to assume that the sales capital ratio is going to drift upward a little bit over time, while I'm also assuming that the margins drift downward. So on an expected basis, I see in 5 years, their sales capital ratio might be up at 0.84, which would be a significant climb from the 0.78 that they're currently at. But it would still leave them significantly lower than their industrial expectation. So effectively on net, in the 5-year forward period, they would still have a significantly lower sales capital ratio than their industrial expectation, but their margin would also still be higher than their industrial expectation, but it would also now just be barely above their industrial expectation. So I think that's a pretty good set of assumptions overall between the two. I like those assumptions. And between all those assumptions, that gets me a return on invested capital in the 5-year forward period of 8%. And we can compare that to the most recent returns on invested capital, which were currently in the most recent year about 15%. So I am assuming that the returns on invested capital are going to come down pretty dramatically as a result of this. That is one thing that to take into account as a result of that. Dr. Crisis, how much TBV does Para have? TBV, tangible book value, I assume is what you're referring to there. Don't think they have much. Yeah, 0 really by my calculation of it. But my calculation isn't necessarily the most standard calculation. Some people would use normal book value and then take out goodwill and equity. They don't really have a lot of tangible value because a lot of their book value comes from goodwill in intangible assets. They're a media company, so a lot of it comes from the fact that they've purchased a significant amount of brands and labels from other companies. So is their debt expensive? No, their debt is actually reasonably cheap. I would say it's not super cheap. I mean, 4.8% is their weighted interest rate. But I mean, that's not bad. That's not bad at all. And 13 years is their weighted maturity. So they have a lot of time to play with it. So they have a huge amount of debt, but they actually have pretty good terms for their debt, all considered. It gives them a lot of time to pay it down. Which they need, because as I was talking about, I was saying that their average net income being 3.1 billion, average interest expenses are about 1 billion, and you know, as I also said, the 3.1 billion, I don't really expect it to change that much over the 5-year period. I do expect it to come down in the short term, but in 5 years, I kind of expect their net incomes on an expected basis to be sort of in the same place, effectively speaking. So the only change is going to be change in EPS due to share counts repurchases over time. So, you know, they do have to pay down their debt, but they have 13 years to do it, which is good because, like I said, 3.1 billion, you can compare that to 19.6 billion. That would be like 6.5 years to pay it down. So you could 6.5 years, you could pay it down, and then suddenly you would have then what, $4.1 billion in net income for the next 6.5 years thereafter. So yeah, I mean, their debt terms are good. They have a lot of debt compared to their market cap. That's the real issue, is that their debt is huge compared to their market cap, because the market has punished them pretty dramatically, which means there's a perceived large amount of risk because you can effectively buy up the market cap cheap relative to the overall amount of debt. But overall, the terms they have on the debt is pretty good. It's actually much better than you would expect for a company with that much debt. Usually, you would expect them to maybe have more like a 6 or 7% interest rate, and you might expect them to maybe only have 5 or 6 years or something like that. So the fact that they actually have only 4.8% in 13 years is pretty decent. Makes me think market it might not really be expecting bankruptcy. Yeah, no, I mean, I wouldn't necessarily say that this has a huge amount of bankruptcy expectation. It's risky. It's risky, but it's not necessarily like so bad that I would say the market's really seeing it as a crazy amount of bankruptcy. There is a risk to default there, which I mean, I'm definitely punishing the company for it. I have a 2% default risk in each year, but that comes off of the back of credit risk. So that has to do with more the fact that the credit markets might shut down in any given year because a crisis could happen, and that could be the time when the company needs to be raising more debt. And so you never know when the company needs to raise more debt, and so that kind of gives them a little bit of a problem there. So it's like there is default risks in the company, but it's not that bad at all. Buy pair of shares and the default swap, I guess. I mean, not bad. That's pretty sound logic. Like I said, I would say the market is punishing them for their debt more than they probably deserve. But I would say the bigger issue is the fact that they're just another company that is in the middle of that cannibalization process, which may or may not go super well. Which for them, it sounds like it's going pretty decently so far. And then like I also talked at the start, the fact that they've had a really good return to form in the theaters in the last year coming out of the pandemic has also helped them to bridge that gap a little bit better as well. Whether or not they can continue to do that in the future, whether or not they're going to have another Top Gun Maverick next year or something like that, I don't know. But so far, they're actually doing better than I would expect. I was pretty pessimistic on companies like this 2 years ago, and so now I'm definitely kind of changed my tone a little bit in regards to that. So anyway, I will give. We basically covered all of the assumptions. I'll go ahead and give the summary of the valuation, which as I said, does include the default risk, which I hadn't already covered, but we'll kind of cover that a little bit. Before also saying that, I will say if you're watching at this point, either live or on the replay, please give us a like. More likes help attract more viewers to the channel, and it'd be very appreciated if you could like it. If you're not already subscribed, please subscribe to the channel. That way you get a notification whenever I go live or whenever I release other content like that. And also the pinned comment in the chat, as well as in the description below, is the link to the Discord, which you can join to be a part of the daily discussions of news of what's going on in the markets, discussions of our own portfolios, analysis of various companies, or the actions of major investors in the markets and things like that. So come be part of the discussion in our community there. PARA, Paramount Global, Class B shares, which I didn't actually cover the difference between the Class B and Class A shares, but it's not really super relevant because it's a layover feature of one of the previous combinations from the company, which had Class A shares, which have a different voting structure from one of the other groups that hold some of their shares, which actually has to do with the 5% of the insiders that is held on it. I didn't cover it because I don't actually think it's really super relevant to the valuation of the company in particular, since this is the share class that is available on the market in particular. So that is what it is. Anyway, 10-year treasury is currently selling for 3.56, 3.57%. Pretty interesting to see the spike in the treasury today, very much in relation to expectations of the Federal Reserve meeting that is going to be tomorrow. I'll see how the market reacts to that. Anyway, I digress. The equity risk premium, as I currently measure it for mature markets, is currently 5.55%. And the discount rate they come up with for Paramount Global after adjusting for company-specific risks, including debt, is 13.63%. Their current cash dividend is 4.25%. 5 years ago, they had sales of 13.1 billion, which, as I said, was in very much a different entity, so it's not really quite apples to apples comparison there. But the current sales of 28.5 billion, that gives them sales of, like I said, apples to oranges sales growth of 16.77% per year for the last 5 years. Though if you kind of break it down closer to more pro forma comparison, like I said, it's more like 1 to 2% or something like that. Sales to capital ratio is currently 0.78 relative to their industrial expectation for the last 3 years on average has been 1.14. The returns on invested capital is currently 12.38%, and their debt to equity ratio is currently 126 to 127%. One default risk in the most recent year, as I have it, a little over 1%. Bill Wang would be proud of that plan. Yeah, I'm sure, definitely. Profit margin currently 15.74%, against their industrial expectation of 9.15%. So the low sales capital ratio compared to their industry, and a relatively high profit margin compared to their industry, which, as I said, I definitely see that starting to reverse, though one will reverse at a different rate more than the other, as I kind of already covered. Profit in the most recent year of 4.5 billion or so, and they're currently selling for $22.61 per share. Probability distribution that I'm using for the company is actually heavily tilted towards the fourth model, which is, I haven't adjusted the probabilities for a lot of my models in the most recent several valuations, but for this one I chose to do that. I wanted to have the fourth model have a significantly higher amount of probability relative to the second model, the more pessimistic model, so that the probabilities lean a little bit more towards these higher revenue, positive ended revenue growth sections, as well as leaning a little bit more towards the positive, higher profit margin expectations as well. Either way, on that, we end up with revenue expectations of anywhere from 16.8 billion in the worst case scenario to possibly 50.3 billion in the best case scenario. On an expected basis, I see 32.7 billion, which equates to sales growth of anywhere from negative 10% in the worst case scenario to possibly 12% in the best case scenario. On expected basis, I see 2 to 3%, which is kind of in line with, as I was saying, the kind of trend that we've seen for the company since 2017, since they became the combined company. So I'm effectively assuming that it'll be about the same in nominal terms, unadjusted for obviously real changeover in asset prices due to inflation. But whatever, I digress. Sales capital ratio on expected basis, I see them climbing to about 0.84 from the 0.78 to 0.84, so a little bit of a climb in the sales capital ratio. Returns on invested capital, I do see them coming down pretty significantly in the returns on invested capital. The 3-year average had been 12% for the last 3 years, and I'm seeing it drop down to 8%, so that's a pretty significant decline. But that has to do with partially their margins coming down, partially the capital being relatively expensive, and partially also the amount of debt that they have on hand. Either way, as I was just saying with the debt, they do have a significant amount of it. I do expect their debt to equity ratio to stay basically in the same range. It'll be maybe a little bit lower than it currently is, probably because their market cap will adjust effectively, because as I'm seeing here, I see them as being a little bit undervalued. And so I see possibly the market cap coming up a little bit, but I also see them as needing a lot of debt in order to fund the content for their business. And so if anything, I see them taking on more debt. It's just a question of how much more debt they'll have relative to their market cap at any given time, since it's a market value weight. So effectively, I'm seeing a market value debt to equity ratio of 121% in the 5-year forward period. And then default risk across the 5 models, pretty significant in each case. Definitely less so in some of the better situations, but significant nonetheless, pretty much across the board, about 2% or so per year across the models, which is, not as bad as it could be, but it's significant. On a compounded basis, that means about 10% chance of defaulting over a 5-year period. And as I've kind of tried to clarify to people don't fully understand this. Defaulting does not mean bankrupt, and which does not mean that the company goes out of business and disappears forever. Default means that there has to be a renegotiation in the terms of the debt due to some sort of hang up in the payments of it. It may not even be that the company is not profitable. It may just be that the company doesn't have cash. There's a difference between having cash and being profitable. And so that's kind of where this default risk adjustment comes from. And I feel like I have to say this more and more, since I've gotten a lot of comments on some of my streams lately, where it seems like people haven't fully understood what I mean by this. So I just want to make that clear, that this is understanding that debt markets are open in good years and they're closed in bad years. And people need to take out debt in bad years, often more than they need to in good years. And so that mix match means that there sometimes is going to be a time when, just due to normal business, a company needs to take out debt, but sometimes that person isn't there to give them the money. And sometimes they need to take out debt, not because they're not profitable, but because they don't have cash on hand. And so understanding that those two things can mean that there is a risk to your business that doesn't necessarily mean the company is an unprofitable business or something like that. So that's, anyway, whatever. A little bit of a diversion there, but as I said, I've gotten a lot of comments specifically on my Zim integrated shipping stream. There was several comments where people were saying I didn't understand default risks, and I was like, well, actually, I think you guys don't understand default risks. But anyway, I digress. So profit margin assumptions, I have anywhere from a worst case scenario of 1% to a best case scenario of 15%. And I have it leaning towards 10%, which gets me an expected value of about 9.5%. As I had said, I definitely see them coming close to their industrial expectation. I'm allowing them to sort of maintain a profit margin that's a little bit above their industrial expectation, while they're still growing their sales to capital ratio. But overall, I do see their profit margins coming down pretty dramatically, because I do think it's a little bit of an aberration that they have those profit margins in the first place, as I was talking about earlier, with the fact that they have a low gross margins relative to their industry, and have such high debt. It doesn't really make too much sense. It sounds like they don't have enough SG&A costs to effectively manage the amount of capital that they have. So anyway, I end up with profit distribution of anywhere from 169 million in the worst case scenario to possibly a best case scenario of 7.5 billion. On expected basis, I see 3.1 billion or so. And that's after using the discount rate across the various assumptions that we have in the models, gets us a present value price of $28.71, which is 27% higher than the current share price. And then we have 5-year forward value targets, unadjusted for the dividends that they will pay out during the period, of anywhere from $6.60 per share to $155.04 per share. On an expected basis, I see $54.39 per share, which, if you compare that to the current share price of $22.61, that gets you an implied return of 19% per year for the next 5 years or so. So pretty significant returns to be had here. There is a pretty significant discount rate, which means a decent amount of those returns are just implied by the risks of the company, and so are just to be had. 27% upside to fair value, so decent amount of upside to fair value to be had here. As I said, like comparing it, for example, to some of the other entertainment companies I've covered, they tend to either be significantly overvalued comparative to really good growth prospects, i.e., things like Netflix or Disney or something like that, or they have really good fundamental numbers, but a huge amount of debt financing like AMC or Paramount or something like that. Obviously, though, like I said, if I had to compare like this one here, Paramount, with say AMC, even though AMC I saw much higher expected returns, I feel like Paramount would be a much safer bet, not only just because it has straight less default risk, but also because the overall umbrella of their brands, I think, is also just a much broader and wider set. Not to mention they're a little bit more parlayed into the theatrical releases, not just broadcasting and streaming entertainment. So in some ways, Paramount's just a lot more diversified of a company as well. So I mean, as I said, this is definitely a little bit of a simplistic overview. You could have definitely done a little bit of a deeper dive into each segment and done a little bit of more of a specific revenue path for each segment, I think, and perhaps come up with a little bit more of a fine-tuned revenue set projections. And perhaps you could have also done a little bit more of a fine-tuned profit margin assumptions based off of doing that as well, which I did not do. So, you know, there's plenty of ways you could improve upon this, but I think this does provide a pretty good overview of the value that Paramount has available here. So that's gonna do it for Paramount Global. Pretty interesting company. I didn't actually already add it to the watch list yet, so I need to do that after the stream, I guess. What was its value score? Value score came in at 0.84. So if we kind of like take a look at what that kind of puts in line, it actually puts it relatively close to where the index comes in with my value score, or with Hovnanian Enterprises, which is a home builder with a huge amount of debt, InMode, which is a pretty interesting medical device company, or GraphTech International, which is a pretty interesting industrial company. So I mean, you know, the pretty middle of the pack as far as like value potential goes. It has upside, but not necessarily a crazy amount of upside to take it on individually relative to a diversified portfolio, which is basically what that value score is supposed to say. It's like, well, if you're thinking about taking this on relative to all the other opportunities, how does it actually stack up? It stacks up relatively well, except comes in close to about where I would say the index does, but not necessarily in the upper echelons of this one standard deviation or above or something like that, which is kind of up here or something like that. So that's going to do it for the stream today. I'm not sure what I'm planning to do for the next stream. I keep kind of waiting to literally like right after my most recent stream to kind of decide when I want to do the next stream, partially because I've just been so busy with my schoolwork, not to mention also working on all the other little spreadsheet tools, as I was talked about a lot in here. Like I said, I spent all weekend working on this, and it's not quite done yet, but it was like 80% done, and I wanted to show that off. And not to mention, we used it a little bit here in the valuation day, which was the purpose of my making it. Is that it's a tool for me to use to make my valuations better.
And at some point or another, maybe I'll provide these tools to other people as well. So anyway, yeah, I'm not sure what I'm going to be valuing next exactly. As I've talked about in the last couple of streams, Micron is pretty high on my agenda, though I don't believe its 10K is out yet. So I'm kind of looking out for that one on the horizon. I already did SMCI, so that one's kind of been done there. I had a few other companies here on my screen that I was taking a look at. So I mean, I already covered Paramount. That one's already done. I already did AMCX. I've kind of been considering doing Stoneco. And then there's Starbolt Cruisers. Then there's Kirkland. There's a few other companies here on my list that I'm considering looking at. Liberty. There's another one that I had actually mentioned here in the stream already. It's one that's technically already in my watch list that I valued before, but I'm either basically need to revalue it or toss it. So maybe that one will be the one that I do. I'm not sure. But you can comment below, or you can join the Discord and comment there if you have your own suggestions for companies for me to value in the near future. So one last time before I go, if you're watching either live or on the replay, pretty awesome that you've made it this far, but please give us a like if you haven't already. And that way you can attract more viewers to the stream. And if you haven't already, please subscribe to the channel. It will make sure that you get notifications when I go live, as well as notifications whenever I release any other content or things like that, as well as join the Discord. As I had just kind of mentioned, it is the pinned comment in the chat, as well as the link in the description below. All right, I'll catch you all again next time.